Philip talks taxes. He has been for over 45 years, and there isn't a human on the planet with more experience solving problems on behalf of taxpayers. He wants to solve your problem, whether you know you have one or not. So if you do have a tax problem, get a hold of him by visiting his website or calling his office. If you don't have a tax problem, your current tax problem is taxes themselves. So let's get into the questions of the day. We asked ChatGPT what it gets asked the most about IRS and tax compliance. So we have a list of questions that you've probably asked yourself. Number one, when is the tax filing deadline? People ask this every year, often wondering about extensions or what happens if they miss the deadline.
The individual income tax return is due April 15th of the year following the tax year. For tax year 2025, your tax return will be due April 15th of 2026. You can get an extension of time to file that return. The extension is obtained by submitting Form 4868. Form 4868 is an application for an automatic extension of time to file the return. That pushes the deadline to October 15th. Now, it gets complicated because if the April 15th or October 15th deadline falls on a weekend, Saturday or Sunday or legal holiday, then it goes over to the next business day. So sometimes it might be April 17th or April 18th, depending on when the 15th falls. Now, here's another wrinkle. The IRS has the authority to issue administrative filing relief. So if there's a fire, flood, hurricane, natural disaster in a particular area of the country, the IRS can issue an automatic filing declaration. They may push the deadline from April 15th to May or June or July. They've got the authority to do that. So you need to keep that in mind as well. If you have a business entity like a corporation or a partnership, those tax returns are generally due a month earlier. So your corporation partnership is due in March. And if you get the extension, your corporation return would be due in September.
There's a section here about extensions. I know there's two types of extension, an extension of time to pay and an extension of time to file. What's the difference between?
Yeah, that's right. The extension of time to file I touched on a minute ago. That's IRS Form 4868. It gives you 6 additional months to file your tax return without penalties. There's no failure to file penalties associated with that. The filing deadline becomes extended, and as long as you file within that extended deadline, you're filing on time. The filing extension, however, does not give you more time to pay the tax. The tax still has to be paid by the due date, which generally for individuals is April 15th. However, IRS Form 1127 is an application for an extension of time to pay the taxes. If you submit that form on or before April 15th, it's possible to get an extension of up to 6 months to pay the taxes without penalties. Interest still applies, but the penalties do not. Now, here's the primary difference between the filing extension, Form 4868, and the payment extension, Form 1127. The payment extension is not automatic. The filing extension is. You just get that form in before the original filing deadline, you automatically have 6 months more to file your return. But that's not the case with the payment extension. You have to give a reason. You have to demonstrate that you exercised reasonable business care and prudence in providing for your tax, but due to circumstances beyond your control, cannot pay on time. There has to be some definitive explanation as to why you can't pay on time, what kind of hardship would arise if you're forced to come up with the money. And now you're in the hands of the IRS as to whether they're going to grant that extension or not.
The next question is, should I file as single, head of household, or married filing jointly? This comes up a lot, especially for people going through a divorce, getting married, or supporting dependents.
The determination of how you file a tax return is based on your marital status as of December 31st. If you're not married on December 31st, you are either a single filer or a head of household filer. You're a head of household filer if you're a single person who is supporting minor children, right? So this is so either single or head of household, single, not married, no children, head of household, not married with children. If you are married as of December 31st, you are either married filing jointly or married filing separately. Whether it's wise to file married filing jointly or married filing separately depends on the facts and circumstances of the case. If you are estranged from your spouse on December 31st and maybe even living in separate residences, but still married, not legally divorced, it would probably be wise to file married filing separately so that you don't have a joint tax liability with a spouse that you're soon to be or eventually could be divorced from. It is also a good idea to consider whether there's delinquent tax liabilities. For example, let's say you've got one spouse that's a wage earner and they have wage withholding coming out of their paycheck, and another spouse that's self-employed and they've not made estimated payments. If you file married filing jointly, both of you owe that that tax liability. Even though one taxpayer paid taxes on their wage income and the other spouse didn't pay any taxes on their self-employment income, both spouses owe the liability jointly and separately under a married filing jointly situation. In some cases, it's better to file married filing separately so that the spouse that earned the wage income and paid all her taxes doesn't have an additional tax liability. The only tax liability is owed by the spouse that has self-employment income and didn't pay their taxes. This needs to be looked at on a case-by-case basis. You can't just automatically make these determinations. We got to evaluate the totality of the circumstances. The circumstances are affected by whether you live in a community property state or not. If you live in Texas or Arizona or Washington State, Nevada, Tennessee, Wisconsin, Texas, I'm not sure I said Texas.
You did.
Those are community property states. And so your capacity to file as married filing separately or married filing jointly might be affected by the laws of those states. So it's not just an easy answer, married filing jointly, married filing separately, something that's got to be looked at carefully.
Question number 3, what deductions and credits am I eligible for? This is commonly asked about the child tax credit, the earned income tax credit, the education credits, and standard versus itemized deductions.
The answer to that question depends on the facts and circumstances of the individual's case. The earned income tax credit, for example, depends on the amount of income that you have and varies depending on your age and whether you're supporting minor children. The IRS has publications on all of these things. If you're curious about the earned income tax credit or the child credit, go to the IRS's website, do a search on the IRS's website for earned income tax credit or child tax credit and get the publication and read it. Itemized deductions or standard deductions, that's really quite simple. Does the dollar value of your itemized deductions exceed the dollar value of the standard deduction? The advantage of the standard deduction is that it's automatic and you don't have to prove anything. You get the deduction no matter what. For 2025, the value of that deduction for a single person is roughly $15,000, and for married filing jointly is roughly $31,000. So that's the amount you get, no questions asked. However, if your itemized deductions exceed that value, it benefits you to claim the itemized deductions. Itemized deductions include medical expenses, state and local taxes to the extent allowable, mortgage interest, charitable contributions. That's generally the heart and soul of it. If you look at IRS form Schedule A, the Schedule A goes along with the tax return. That's the schedule that lists itemized deductions. If you've got $40,000 worth of itemized deductions as a married filing jointly, you're better off claiming the itemized deductions because they exceed the standard deduction by $9,000. If you add up all your itemized deductions and they come up to $29,000, you're better off claiming the standard deduction because it's worth $31,000. The other problem with itemized deductions is you have to prove it. If the IRS challenges your tax return, you have to prove every dollar. If you are unable to prove all of the itemized deductions and the IRS disallows them and it drops below the standard deduction, they're going to give you the standard deduction as a result of the audit.
Question number 4, do I need to file my taxes at all? This is a common question among students, low-income earners, and Social Security recipients.
The obligation to file a tax return depends on the amount of income. The obligation to file a tax return is not contingent on whether you owe tax or not. I've had people say to me, well, Dan, I didn't file a return because I knew I wasn't going to owe anything. It doesn't matter whether you owe taxes or not. The obligation to file a tax return depends on the receipt of income. If your income exceeds a certain amount, and that changes every year, and it depends on your filing status, single, head of household, married filing separately, married filing jointly, or a qualifying widow, all of the income amounts are different based on those filing classifications. Go to the IRS's website and ask that question, who's required to file a tax return? They'll give you a publication that shows year by year the filing statuses and the income brackets that determine whether you're required to file a return or not. If you're not required to file a tax return, you don't have to file a return. However, if the IRS owes you money, even if you're not required to file a tax return, perfect example of this is a student. A student files as a single taxpayer. They get their $15,000 standard deduction just like everybody else. So maybe that student only earned $10,000. In earning that $10,000, they had wage withholding. They're not required to file a tax return, but they're going to file that tax return to get their wage withholding back, right? The IRS has got their money, and the IRS is obligated to give that money back if they don't owe a tax liability. I hear people say to me all the time, I didn't file my return because I knew they owed me money. Here's what the problem is, and this is a big deal. If you file your tax return more than 3 years late, you waive your right to either a refund or a credit. So not only will the IRS not give the money back to you if you're more than 3 years late, they won't credit that overpayment to any other tax year. So if you owe for year 3, but you got a refund for year 1, and you file that year 1 tax return more than 3 years late, you're not getting that money credited to your delinquency. They're just going to keep it. You waive your right to a refund if you don't file that tax return within 3 years of the due date. There is no statute of limitations on the IRS's right to assess a tax liability against an individual from the date the return is filed. You file your tax return for 2025 in April of 2026. The IRS has until April of 2029 in which to assess a tax. All right. So that means they got to audit you within that 3-year window if they want to assess additional liabilities in connection with that return. But if you don't file a tax return, there's no statute of limitations on the IRS's ability to assess a tax against you if you didn't file a return. They can go back 3 years, 6 years, 9 years. Now, they typically don't do that, right? There's some administrative limitations on how far they'll go back, but the law allows them to go back to day one if no tax return was filed. So
Day
it's
one
exactly
being
the opposite.
1918, the implementation of the IRS.
Theoretically, they could. If you're talking about a 95-year-old guy, they could say, prove to us you filed your tax return in 1946. And that's the challenge. The burden of proof is on the taxpayer to prove that they filed. The IRS would back off of that. There's no reasonable person in the IRS's Office of District Counsel or Area Counsel that would prosecute that. But the fact of the matter is, legally speaking, they could do it. They have administrative limitations. Remember, this is an administrative rule, not a legal rule. The administrative limitation is that they generally will not go back more than 6 years to chase a delinquent tax return for exactly the reasons that we're talking about. But you need to understand that this is the complete opposite of what happens if you don't file a return and they owe you money, right? That 3-year rule is hard and fast. There's only one exception, and it's so obscure that it never applies. If you don't file that return within 3 years of the due date, your refund is gone. If you don't file a return within 3 years of the due date and you owe them money, they can chase you, and they generally do.
The next question is, why is my tax refund so low? Or why do I owe taxes this year?
Well, it depends on your income and expenses.
Or why do I owe taxes this year? And this often comes up, especially after changes in the tax law or specific income earned. It also is asked by people who often blame this on withholding issues or credit phase outs.
Now, the only way to answer why a given person owes more money in taxes or their refund is smaller has to be answered based on that individual's facts and circumstances and income tax return. Every individual's circumstances are different. When the Tax Cuts and Jobs Act was put into effect in January of 2018, there were tax cuts across the board for middle income Americans. The bottom 80% of income earners in the United States had their tax liabilities considerably reduced. With the Big Beautiful Bill Act having been signed into law, those Tax Cuts and Jobs Act benefits mostly have been made permanent. Right? And there's additional benefits that are added as well. We've talked about this in prior podcasts. Here's what the IRS did right away in January of 2018. They adjusted the withholding tables so that your employer was taking less money out of your paycheck every month because your tax liability was going to be lower. When people filed their tax returns in April of 2019, a lot of people were screaming, my tax refund is lower than it was last year. This Tax Cuts and Jobs Act really cost me more money. No, it didn't. The IRS took less money out of your paycheck to begin with. And so that's why your refund was lower. You got to understand that a tax refund is not a free gift from the government. You get a tax refund because you overpaid your taxes in the first place. And when the IRS adjusts the withholding tables to reduce how much money is taken out of your pocket, what that means is you got more money in your paycheck every single week or month, and that means less money coming back to you from the Treasury at the end of the year, which is your own money to begin with. There's a lot of confusion about these refunds. This is something that people need to pay attention to.
Question number 6 is, how do I track my tax refund? Tons of questions about the IRS's Where's My Refund tool and why refunds are delayed.
There's a lot of reasons why refunds are delayed, and not the least of which is identity theft. The Treasury Inspector General for Tax Administration said that identity theft is the crime of the century. The IRS is doing everything they can to minimize with the river of data flowing into the IRS every year, that hundreds of millions of tax returns and literally billions of information taxation returns. Smart thieves figure out how that data and how to file false tax returns with your name and social security number on it to hijack your refund and more. There's been cases of people that have filed hundreds of false tax returns, intercepting refunds and getting that money shipped into bank accounts here and there across the country and sometimes across the world. It's very difficult for the IRS to stop this. They spend hundreds of millions of dollars every year on security. That's something else that they're going to be working on now under the big bill with the IRS appropriation that's coming down the pike here. But security is a big deal. And this is one of the key reasons why refunds get delayed. Another reason why refunds get delayed is if you've got a substantial refund, 5-figure refund, the IRS has a revenue protection function inside of their agency. And so when you got these giant refunds, they want to look at that stuff before they release that. Now, if you're having trouble with the refund, you know you got a refund you're entitled to, it's being held up, you need to check with the Office of the Taxpayer Advocate. There's a link on the IRS's website. If you go to their homepage, there's a link for the Taxpayer Advocate. On that page, there's a separate link for taxpayer advocates in your area. And you can find the Office of the Taxpayer Advocate in your state. That link will give you their address, phone number, fax number, and email. The Office of the Taxpayer Advocate will work under email if they get an email from a taxpayer in the first place, and then they get authority to email back and forth. You can use the Office of the Taxpayer Advocate to find out where your refund is.
Question number 7 is, how do I file a tax extension? This is asked close to the April deadline, and many want to know if an extension also delays payments. This is an important question they asked so many times that they put it in the top 10 twice, so it might as well be answered twice.
Well, let me rehash it again then. Form 4868 gets an extension of time to file the return. It's a 6-month automatic extension. It is not an extension of time to pay the tax. In order to get an extension of time to pay the tax, you must use IRS Form 1127-1127. It's called an application for an extension of time to pay the tax. It is not automatic. You have to give the IRS good reason why you do not have the capacity to pay and how payment would cause a hardship, and then it's within the discretion of the IRS to grant the extension or not. Now, they might not do a thumbs up or a thumbs down. It might not be a simple yes or no answer. They may say, we'll give you 2 months to pay. We'll give you 4 months to pay. They might not give you the full 6 months, but they also might say, no, you got to pay on April 15th. And if you don't, now you have penalties.
Question number 8 is, how do I file taxes if I'm self-employed or freelance? This is often asked by gig workers, DoorDash people, Uber, freelance. This is in relation to 1099s, self-employment tax, quarterly estimated payments, and business write-off.
That's a good question. And we got so many gig workers out there, people that are working side jobs. We used to call it a side hustle. Now they call it a gig. You might be working a W-2 job where you got wage withholding coming out of your paycheck. And then you might have your side job where you're doing computer work or marketing. Maybe you're a shade tree mechanic helping people change their oil and rotate their tires, and you charge a fee for that. That is considered self-employment income. And you must report that income. You use IRS Form Schedule C for Charlie is where you list your self-employment income and all related expenses. The difference between self-employment income and your expenses is your net profit, and you pay tax based on your net profit. As a self-employed individual, you have a responsibility to make quarterly estimated payments based on what you project your tax liability will be. In order to understand what that's going to be, you got to keep a profit and loss statement on an ongoing basis, at least on a quarterly basis, if not on a monthly basis. Based on your monthly profit, you can make estimated payments or quarterly payments. The obligation is to make them at least quarterly. The better idea is to make them monthly, so you're always on top of the situation. That's why I recommend a monthly profit and loss statement, so you monitor your situation as you go through it. In my book, Dan Pilla's Small Business Tax Guide, I've got a whole section in there that shows you exactly how to do this to stay on top of it. If you have a wage job and self-employment income as well, you can increase wage withholding on your paycheck to cover your self-employment income. You don't have to physically make the quarterly estimated payments. You can do it through wage withholding. If you know, for example, that you're going to have an extra $2,500 of tax liability over the year, increase your wage withholding on your paycheck to cover that $2,500. Now,
question number 9 is, how do I fix a mistake on my tax return? This includes missed income, wrong social security numbers, wrong filing status, and how to amend a return with a Form 1040X.
Well, that's exactly the answer. Form 1040X is the form you use to amend a tax return. You've got 3 years from the date the return is filed in which to amend it. If there's a mistake on the return, the rules say that you should amend the return. There's no specific law that requires a taxpayer to affirmatively amend a tax return that there's a mistake on, all right? But you should do it, because if the IRS finds the mistake and the mistake is in their favor, they're going to charge you penalties and interest as a result of the underpayment. If the mistake is in your favor, they got to refund the money, and they'll refund interest on the money as well. You should amend the return. There's no law that says you have to. Form 1040X is a relatively simple form, and all you do is show on the 1040X the amount of money that was original. Let's say you made a mistake with your income. You reported your income at 50 grand and it should have been reported at 40 grand. So you paid more money than you owe. On the amended tax return, you show the amount of income reported on the original return. You show the amount of income reported on the amended return. So it goes from 50 to 40. The difference is 10. And then you provide a simple explanation. Why was it overstated? I made a mistake, or I looked at the wrong form, or whatever the situation is. You can explain that and submit that amended return. If you're outside of that 3-year rule, then the IRS is not going to process the amended return, whether the mistake's in your favor or their favor. You're not getting that amended return process. So they're not getting their money if you owe it to them. You're not getting your money if they owe it to you.
Question number 10 is, what happens if I don't pay my taxes?
If you don't pay your taxes, the IRS will resort to enforced collection. Let's say you owe the IRS 50 grand. They're going to send you a series of notices that say, hey, you owe us some money. The notices get increasingly stern in their language. The last letter in a string of what I call preliminary collection notices is referred to by the IRS as a CP 504 letter, and it's a threat to levy a state tax refund. And in that CP 504 letter, they tell you that they can file a tax lien against you, start levy action on other assets, and that if you owe more than $50,000, report you to the State Department as being seriously delinquent in your taxes. The State Department can actually suspend your passport if that's the case. Before the IRS can levy a paycheck, a bank account, seize an automobile, a Social Security check, or anything like that, they have to mail a letter known as a final notice of intent to levy and notice of your right to a hearing. When you get that final notice letter, you have 30 days to either pay the tax or file a request for a collection due process hearing. The due process hearing is the most important right taxpayers have when dealing with the IRS in a collection environment. If you submit a request for a collection due process hearing on time, a number of important things happen. Number one, it stops collection action in its tracks. They can't levy, they can't seize, they can't seize a nickel's worth of your assets while that due process hearing is pending. Number two, the case gets handed off to the Office of Appeals, whose written job description is to negotiate some kind of settlement with the taxpayer. That is to say, they have to consider collection alternatives. Maybe you want penalty relief. Maybe you've got an asset that you can sell and need time. Maybe your income and expenses are such that you can't make any payment and you need your case closed as currently not collectible, or maybe you want to submit an offer in compromise. All of these things and more are considered collection alternatives, and the appeals office has to consider every single one of them that you request. The next thing that the appeals office has to do is called the balancing test under the statute. The balancing test requires the IRS to consider the conflicting interests between the IRS's desire to collect the money and the citizens' need to have collection be no more intrusive than necessary. These interests have to be balanced out, and there has to be a reasonable resolution based on that friction. If you can't come to a resolution with the Office of Appeals, the decision of appeals is further appealable to the United States Tax Court. So you actually have leverage to force the appeals office to do the right thing. Right to a collection due process hearing is so important that every citizen needs to know about this, right? Whether you got a current tax problem or not, you need to know about this. In my book, How to Get Tax Amnesty, I have several chapters devoted to how this process works. And every citizen needs to know about it, because it can do from IRS levies and seizures and liens, and the whole gamut of collection tools that are available to the agency can be neutralized by the collection due process appeal channel.
So in short, taxpayers, if you don't pay your taxes, call him, because he can help. He can solve the problem for you. And that's all for this week. Thanks for watching. And remember, there's no such thing as a hopeless tax case. If you think yours is the exception, get a hold of Dan. He will help you see the daylight. And Dan, let them know where else they can follow along with your Taxpayers' Rights Crusade.
Follow me at Pillow Talks Taxes. I'm primarily on TikTok, Facebook, Truth Social, and right here on YouTube. Make sure you subscribe, like, and share these videos, especially with your federal and state legislators. And if you have a tax problem, go to my website, TaxHelpOnline.com. It's all one word, TaxHelpOnline.com. Buy any book off my website at any price point. I mentioned two of them in this podcast, Dan Pilla's Small Business Tax Guide and How to Get Tax Amnesty. Get any book off my website at any price point, and you get a free 15-minute consultation directly and personally with me.